Financial plan, the cash flow statement. The statement of cash flows is one of the 4 statements issued by a business. The statement of cash flows describes the cash flows into and out of the organization. Its particular focus is on the types of activities that create and use cash. Cash flows are broken up into 3 activities: operations, investments, and financing. I'll get a little more into that in just a few slides. Though the statement of cash flows is generally considered less critical than the income statement and balance sheet, it can be used to discern or recognize trends in business performance that are not readily apparent in the rest of the financial statements. It is especially useful when there is a divergence between the amount of profits reported and the amount of net cash flow generated by operations. There can be significant differences between the results shown in the income statement and the cash flows in this statement for the following reasons. There are timing differences between the recordation of a transaction and when the related cash is actually expended or received. Management may be using aggressive revenue recognition to report revenue for which cash receipts are still sometime in the future. The business may be asset intensive and so requires large capital investments that do not appear in the income statement except on a delayed basis as depreciation. Many investors feel that the statement of cash flows is the most transparent of the financial statements. It's the most difficult to fudge or manipulate, and so they tend to rely upon it more than the other financial statements to discern the true performance of a business. The statement of cash flow summarizes the firm cash flow over a period of time. Firm's cash flows fall into 3 categories. The operating cash flows, which is cash flows directly related to the sale and production of the firm's products and services. Investment cash flows are cash flows associated with the purchase and sale of both fixed assets and equity investments in other firms. And financing flows, cash flows that result from debt and equity financing transactions include incurrence and repayment of debt, cash inflow for the sale of stock, and cash outflows to repurchase stock or pay cash dividends. There are 2 types in which to present the statement of cash flows. The direct method, which requires you to present cash flow information that is directly associated with the items triggering cash flows, such as cash collected from customers, interest and dividends received, cash paid to employees, cash paid to suppliers, interest paid, and income taxes paid. Under the indirect approach, the statement begins with the net income or loss reported on the company's income statement, and then makes a series of adjustments to this figure to arrive at the amount of net cash provided by operating activities. The indirect method of presentation is more widely used than the direct method because the information required for it is relatively easily assembled from the accounts that a business normally maintains in its chart of accounts. The indirect method is less favored by the standard setting bodies since it does not give a clear view of how cash flows through a business. Operating activities refer to the primary revenue generating activities of a business, such as cash received from the sale of goods or services and cash paid to suppliers. The amount of cash flows from operating activities can be approximately derived from the following formula. EBIT plus depreciation equals cash from operating activities. EBIT is earnings before interest and taxes. This information is useful for determining how much cash the primary operations of a business is actually spinning off, if at all, which is not always apparent if you only rely on the net income figure listed in the income statement. Accrual counting can yield a net income figure that is quite different from cash flows. Cash flows from investing activities is a line item in the statement of cash flows. This line item contains the sum total of the changes that a company experienced during a designated reporting period, investment gains or losses. as well as from any new investments in sales of fixed assets. Items that can be included in the investing activities line item include the following: purchase of fixed assets, which would be a negative cash flow; sale of fixed assets, which is a positive cash flow; purchase of investment instruments such as stocks and bonds would be a negative cash flow; sale of investment instruments such as stocks and bonds would be a positive cash flow; lending of money, negative cash flow; collection of loans is a positive cash flow; and proceeds of insurance settlements related to damaged fixed assets, positive cash flow. The cash flows from investing activities line item is one of the most important items on the statement of cash flows because it can be a substantial source or use of cash that significantly offsets any positive or negative amounts of cash flow generated from operations. It is particularly important in capital-heavy industries such as manufacturing that require large investments in fixed assets. Cash flows from financing activities is a line item in the statement of cash flows. The line item contains the sum amount or total of the changes that a company experienced during a designated reporting period that were caused by transactions with owners or lenders to either provide long-term funds to the company or to return those funds to the owners or lenders. If the company is a non-for-profit, then you would also include in this line item all contributions from donors where the funds are to be used only for long-term purposes. Items that can be included in the financing activities line item are sale of stock, which is positive cash flow; repurchase of company stock, which is a negative cash flow; issuance of debt, such as bonds, which is a positive cash flow; repayment of debt is a negative cash flow; payment of dividends is a negative cash flow; and donor contributions restricted to long-term use, positive cash flow. Large positive or negative balances in the cash flows from financing activities should be evaluated in depth since it can denote the need for a large loan to support ongoing negative cash flows from operations. Thus, large amounts in this line item can be considered a trigger for a more detailed investigation. Summary. So cash helps companies expand, develop new products, buy back stock, pay dividends, or reduce debt. That is why cash flow statements is highly valued more than just about any other financial statement or measure out there, including earnings per share. It's also why many analysts look to cash flow from operations for insight into the core of a company's cash generation engine. Almost all cash flow measures are influenced heavily by the state of a company's cash from operations, which in turn is heavily influenced by a company's net income. Higher revenues, lower overhead, and more efficiency are big drivers of cash flow from operating activities. For these reasons, investors often look for companies that have high or improving cash flow from operations but low share prices. The disparity often means the share price will soon increase. It is important to note, however, that having negative cash flow for a time is not always a bad thing. If the company is a net spender of cash from operations for a time because it is introducing a new product, for example, this could pay off in the end if the company's operations generate more cash. On the other hand, if the company has a negative cash flow from operations because it made a poor managerial decisions, then the long-term benefit might not be there. So here's two questions. What is working capital, and how do changes in working capital affect a company's cash flow? I want a paragraph on each of these, and it's okay that if you want to explain that second question, how do changes in working capital affect a company's cash flow, if you need a couple paragraphs for that. I don't want 2-3 pages. I just want you to explain it in a brief but concise manner. You're going to have to do a little bit of research on that, and so because you are going to do research, you will have to provide works cited as well. All right, thank you.